You've noticed it. 30-footers that used to be firm are suddenly negotiable. 40-footers sitting for months. Listings that feel like they're quietly bleeding. Boats that were untouchable in 2021 are now getting cut again and again. And people keep asking the same question. Why are sailboats in California suddenly cheap? Here's the real answer. It's not one reason. It's not a crash. It's a structural correction. California is in the middle of what industry people are calling the Great Decoupling, a divergence between what the boat is worth in theory and what it costs to own in reality. So by the end of this video, you'll understand exactly why prices are dropping, why inventory is stalling, which boats are getting devalued the fastest, which ones still hold value, and how to buy in 2025 through 2026 without stepping on a financial landmine. And stay to the end because I'm giving you the California Sailboat Deal Filter, a pre-offer checklist that instantly separates a real bargain from a cheap boat that is actually negative value. Let's get into it. First, the myth everyone loves. It's just too many boats. Directionally true, structurally incomplete. Yes, there's surplus inventory. Yes, there's a glut in the 25 to 50-foot segment. Yes, sellers are competing for fewer buyers. But the real reason prices feel like they're falling off a cliff is that California has changed the ownership equation. The purchase price is no longer the main cost. The purchase price is the admission fee. In a lot of coastal California, the boat is becoming cheaper because the slip is becoming more valuable than the ship. That's the decoupling. And the decoupling is being driven by 5 forces that are hitting all at once. 1. The macro environment, inflation and interest rates. 2. Financing stagnation and the end of FOMO. 3. Operational overhead exploding, slip fees and insurance. 4. Maintenance costs driven by labor shortages and parts inflation. 5. Regulation squeezing older boats, plus the end-of-life cost problem, abandonment and disposal. Put those together and you get exactly what you're seeing. Asking prices pretending, sold prices falling, days on market rising, and the bottom tier getting liquidated. Now let's walk through it cleanly. Force number 1, inflation and the reversal of the wealth effect. In 2024 and 2025, inflationary pressure around 4.5% changed discretionary spending patterns. This matters because a huge chunk of boat ownership sits in the middle-class discretionary zone. About 61% of boaters have annual household income of $100,000 or less. So when essential goods rise, the boat becomes the first asset to get questioned. And in California, that pressure is amplified. Cost of living, housing, utilities, higher than national averages. So the optional expenses get cut first. That means more owners exit, more listings, more motivated sellers. But inflation alone doesn't create a sudden cheap market. The market only breaks when the buyer stops buying. Which brings us to force number 2, the interest rate barrier. During the 2020 to 2022 boom, low rates and cheap money created a buyer culture driven by payment, not price. It was FOMO financing. People bought boats they were not prepared to maintain because the payment felt manageable. Then that world ended. By late 2025, moving into 2026, interest rates are expected to remain around 4% through 2026, and the cost of borrowing for a depreciating asset stopped feeling attractive. So buyers became cautious. Credit became expensive relative to the psychology of boat ownership, and you get the wait-and-see mindset. That matters more than people admit, because a wait-and-see buyer is not a buyer. They're a browser, and browsers inflate inventory without clearing it. That's how you get stagnation. And stagnation creates a very specific pattern. Asking prices stay nominally high. Sold prices trend down. Discounts widen. Days on market rise. That's exactly what the Q4 2025 indicators show. Inventory for yachts over 40 feet, 880 units late 2024 to 867 units late 2025, down 1.5%. So inventory isn't exploding there. But median asking price went up, $430,392 to $439,000, up 2.0%. Sellers are still anchored. Median sold price dropped $345,160 to $335,000, down 2.9%. Realization is falling. Average days on market increased from 150 to 172 days, up 14.7%. That's slower velocity. Median price discount increased from 6.5% to 7.2%, up 10.8%. Discounts are widening. And total sales volume by value slipped slightly, $183 million to $181 million, down 1.1%. That combination is a market searching for a floor. Sellers are still living in the old world, buyers are living in the new one. The delta between expectation and reality is the correction. Now here's where California becomes uniquely brutal. Force number 3. The operational overhead crisis. This is the part that makes boats feel suddenly cheap, because the market is repricing not the boat, but the burn rate. Let's say a boat is listed at $20,000. You think, that's nothing, I can afford that. But in many coastal regions, the purchase price is now the smallest line item. The classic benchmark was the 1.5% rule, annual insurance around 1.5% of the boat's value. That benchmark broke. Insurance premiums increased 12% in 2024, driven by higher repair costs and more frequent claims. So even a cheap boat becomes expensive to simply exist.
If you own a $20,000 boat and your insurance is $1,000 to $1,500 annually, that's not insane by itself. But add slip fees, add maintenance, add haul-outs, add compliance. Now the boat starts costing you like a car while delivering you like a hobby. And slip fees are the real knife, because California marina economics are changing. Corporate consolidators have acquired small boat yards and marinas and often re-optimize them for high-margin powerboats or luxury yachts. That reduces space for traditional sailboats, so the middle tier gets displaced and rates climb. In San Diego, seasonal dockage for a 40 to 49-foot sailboat reached $30.50 per foot in 2023. Then you have the reset pressure. In Coronado, Glorieta Bay Marina proposed a 3-year reset because their current rates were 9% to 35% below the San Diego Bay market average. Then you see the disparity pattern elsewhere. Dana Point Marina averaged 7.9% increase across sizes and still estimated 39% to 62% below market. That is a warning sign, not a comfort, because below market is not a discount forever. It's delayed repricing. And then you see ownership models like Emery Co's 40 by 13.5 slip with 46K to 48K buy-in. The message is clear. In parts of California, the scarce asset is not the boat, it's the place to keep the boat. And when the slip gets expensive, owner holding power collapses. Here's the simplest version. If your slip costs $1,200 per month and your boat is worth $10,000, you are burning the boat's entire value every 8 months just in storage. That means the seller isn't negotiating about the boat, they're negotiating about stopping the hemorrhage. So suddenly cheap happens when sellers capitulate to end the burn rate. That's why some boats are being fire sold, not because the hull got worse, because the carrying cost got insane. And this is why free boats are not free. The phrase high cost of free boats is not a meme, it's a structural truth. You can buy the boat cheap, you cannot own it cheap. Now, force number 4, the labor market and the maintenance premium. This is where older boats get deleted. California is dealing with a shortage of skilled marine mechanics, and labor rates in places like the Bay Area and Silicon Valley have reached levels that make major repairs economically irrational for older vessels. Look at the projected 2026 hourly rates. San Francisco, $33.62 average, top 10% at $40 plus. San Jose, $36.34 average, top 10% at $45 plus. Berkeley, $34.94 average, top 10% at $42 plus. Los Angeles, $31.91 average, top 10% at $38 plus. And then you have Springville showing $52 average, top 10% $63 plus, annual mean salary $107,805. Now stack that with a 12% increase in marine parts and materials.
Now imagine what a simple overhaul becomes. A basic engine overhaul or hull repair can exceed $10,000. For an older boat worth $20,000 to $40,000, that is a deal breaker. And this is where the market flips. Because the boat is no longer priced by romance, it's priced by the repair risk. So buyers stop paying for potential. They pay for documentation. This is the maintenance premium. The market places an extreme premium on turnkey condition. A boat with a clean, recent survey and documented maintenance records can be worth significantly more than Blue Book value because it mitigates repair risk. Meanwhile, poorly maintained legacy hulls become toxic assets, which leads directly into force number 5, the generational handoff and split market behavior. California is experiencing a massive ownership transition. Baby boomers have historically been primary owners of Bluewater sailboats, and now they are aging out of the sport in large numbers, and they are exiting simultaneously. That creates a glut of inventory, especially boats built in the 1970s and 1980s. So supply rises in the legacy segment, but the buyer base shifted. Millennials and Gen X have different requirements. They are time poor, demanding careers, family schedules, so the project boat is no longer seen as a hobby, it's a burden, which creates the split market. Winners, modern, turnkey cruisers with updated interiors, efficient rigs, and more reasonable insurance outcomes. Losers, older fiberglass boats, especially 25 to 30 footers that are poorly maintained. Those losers can sell for as little as $2,000, and at that point, you're not buying a sailboat, you're buying a disposal problem. And then there's a preference shift layered on top. There's a trend toward multi-hulls and powerboats. Catamarans are prized for all-around view salons and stability and can maintain or increase value if well maintained. Traditional monohulls with cave-like interiors and bridge deck sleeping quarters are becoming harder to sell. And for many younger buyers, the simplicity of a powerboat, turn the key and go, feels more attractive than sailing's complexity and learning curve. So in California, older monohulls get hit from both sides. More supply from aging owners, less demand from time-poor buyers. That's a recipe for price compression. Now add the California-specific hammer, regulation. This is the regulatory squeeze. Two issues dominate your risk profile now: copper anti-fouling paint regulation and invasive species protocols impacting trailer sailors. Let's start with the big one, copper paint. Copper-based anti-fouling paint has been standard for decades, but copper leaching has impaired water quality in numerous California marinas, so the state is moving. Assembly Bill 773 in the 2025-2026 session requires the Department of Pesticide Regulation to complete a reevaluation of copper-based anti-fouling products by January 1, 2028. And the timeline is real. By June 1, 2027, studies on low leach rate paint effectiveness must be completed. By January 1, 2028, DPR must finalize reevaluation of copper-based anti-fouling products. By January 1, 2028, State Water Board and DPR must release best methods for marinas. By January 1, 2028, Cal EPA must post compliance methods on a public website. And there's an immediate piece: partial suspension of enforcement for boats using approved paint. Here's why this crushes older boats. Uncertainty kills buyer confidence. A potential buyer looks at an older hull and thinks, am I going to be forced into a multi-$1,000 hull stripping job? Am I going to have to switch to expensive non-biocide alternatives? Will those alternatives require more frequent professional cleaning? And that fear becomes a discount. So the market starts pricing in the probability of future compliance cost. That pushes older boats lower. Now the invasive species protocols. Effective April 14, 2025, motorized and trailered vessels entering Folsom Lake or Lake Clementine must have intact and verified decontamination seals to prevent the spread of the golden mussel. This reduces the utility and flexibility of smaller, affordable trailer sailors, so even the cheap entry boats lose part of their value proposition, which again pushes price down. So now we have macro pressure, financing stagnation,
overhead explosion, labor cost spike, generational supply wave, and regulatory fear. But there's one final piece that explains the extreme end of suddenly cheap, the end-of-life paradigm. This is where a boat's value becomes negative because disposal is expensive. In Morro Bay, the Harbor Department reports average cost to dispose of a surrendered vessel under 30 feet is $2,818. Boats over 30 feet cost $4,327 on average. And if the vessel is officially abandoned and requires legal title processes like a lien sale before demolition, costs go even higher. So when the cost to get rid of the boat exceeds the market price, the rational move for a lot of owners becomes abandon. That's why you see the growth of programs like SAVE, the Surrendered and Abandoned Vessel Exchange Program administered by California Division of Boating and Waterways. And the grant awards show scale. Contra Costa County Sheriff, $275,000 for waterway abatement and removal. Yolo County Sheriff, $140,000 for removal and disposal. Port San Luis Harbor District, $132,000 for derelict vessel abatement. Ventura Port District, $110,000 for vessel destruction and storage.
Sacramento Police Department, $85,000 for a vessel turn-in program. San Joaquin County Sheriff, $70,000 for removal and safety. Alameda Police Department, $100,000 for harbor abatement. Humboldt Bay Harbor District, $30,000 for removal of 6 high-risk vessels. That's public money being spent to clean up what is essentially a market failure. And here's the point for you as a buyer. Those cheap boats you see online, the $2,000 listings, the free if you tow it, they are often the same boats flowing toward these abandonment programs. The cheap listing is not a deal, it's a warning. Now you might be thinking, okay, but is all of California like this? No, this market is highly regionalized. San Diego stays premium. It has high demand for premium slips and a more resilient high-end yacht market. The analysis even points out examples like a Hylas H57 at $1.8 million remaining viable at the top end. Meanwhile, areas like the Sacramento Delta and the Central Coast see higher concentrations of distressed inventory and abandonments. So the truth is, California does not have one sailboat market, it has two. The turnkey market, where value still exists, and the project market, where value is being deleted. That's the great decoupling in plain language. Now let's talk about what happens next. The forecast is cautiously optimistic for stabilization in 2026. Manufacturers adjusted production to account for high dealer inventory. There's an expectation that easing interest rates and larger tax refunds could stimulate demand in the second half of 2026. But the bigger trajectory is that the market will keep transitioning toward a luxury-only model. High net worth buyers remain. The middle-class ownership model is under stress. And you can see that in the broader projections. Global sailboat market projected to reach $8.16 billion by 2033, with CAGR in the 3.3 to 4.9% range. Global boat slip rental projected to grow from $4.20 billion to $7.90 billion, CAGR 7.1%. U.S. outdoor recreation economy around $1.2 trillion and continues growing, about 2.3% of GDP. U.S. boating participation around 85 million people, roughly 1 in 4 adults. So sailing isn't dying, but the affordable California boat model is under existential pressure because infrastructure costs are rising faster than boat values. Now here's the part you actually care about. What do you do with this? If you're buying, this is leverage, but you need to aim correctly because the opportunity is real and the traps are expensive. Here's the California sailboat deal filter. Use this before you make an offer. If a boat fails 2 or more of these, it's not a deal, it's a financial trap. 1. What is the true monthly burn rate? Slip plus insurance plus basic upkeep, not best case, realistic case.
1. If the burn rate is high enough that holding the boat for 6 months would hurt you, your exit is fragile. 2. Is it turnkey by documentation, not by words? The market is placing an extreme premium on turnkey condition. If there's no clean recent survey and no maintenance records, you are buying unknown repair risk in a high labor cost state. 3. Is the boat in the project boat age and condition zone? Because millennials and Gen X are time poor, project boats are being rejected. That means your resale pool is thin. If you buy a project boat, you are signing up to be the last buyer. 4. Price the labor reality. In California, mechanic hourly rates in major regions sit in the low to mid-30s per hour on average, with top rates $37 to $45 plus, and that's before parts inflation. If a known issue could trigger a $10,000 repair and the boat is worth $20,000 to $40,000, your math must be ruthless. 5. Price the regulatory risk. AB 773 pushes copper paint reevaluation toward a 2028 deadline. Buyers are discounting older boats because they fear future hull stripping and conversion costs. If the hull paint situation is unclear, treat it as a cost you will eat. 6. Understand the disposal floor. If the boat is cheap enough that disposal could cost more than the purchase price, you are not buying an asset, you are buying an obligation. 7. Location matters more than you think. San Diego is more resilient at the top end. The Delta and Central Coast show more distressed inventory and abandonment dynamics. Your local market structure affects how fast you can exit. If you're selling, the playbook changes too. Reality matters more than hope. Invoices sell boats in 2026, not stories. If you want liquidity, you need a clean file. Survey, records, proof of maintenance, and pricing aligned to today, not 2021. And understand the brutal truth of carrying cost. Waiting 6 months often costs more than cutting now, because slip fees and insurance don't wait with you. Now, let's close the loop on the title. This is why sailboats in California are suddenly cheap. Because California is shedding its bottom tier. The market is not collapsing. It is maturing into a world where the ownership cost is the real price. And when ownership costs explode, the boat has to get cheaper to make the equation work. So yes, prices are dropping, but it's not random. It's the great decoupling. The slip is more valuable than the ship, labor is more expensive than the hull, regulation is repricing older designs, and the bottom end is being liquidated into abandonment programs when value goes negative. If you're buying, this is the best buyer leverage in over a decade, if you target the right segment. Turnkey, documented, maintained boats become bargains.
Project boats become traps, and that's the uncomfortable truth. Sailboats in California aren't suddenly cheap. The wrong sailboats are suddenly cheap. Tell me what you're seeing right now. More listings sitting, bigger discounts, more as-is language, more abandoned-looking boats? And if you want the next video, I'll break down exactly how to negotiate California sailboats in this market, including what to ask brokers to expose hidden burn rate and how to use days on market as leverage without overplaying your hand.